Welcome back, everybody. So for today, we looked at chapters 1 through 3, and now today we're doing chapter 4. Now, the very introduction of accounting to how accounting is going to be done in this class, and then now we're going to be looking at the rules and the guidelines that actually govern why we do bookkeeping today. All right, and we're also going to be looking at a cycle that we must follow to accomplish our end goal, which is to get our financial statement the way it is. Is everything okay over there? Okay. So here, chapter 4, accounting cycle. All right, so what is an accounting cycle? It's pretty straightforward. It is basically it's a method or a set of rules, right, to ensure the accuracy of accounting. But ultimately, it's also a process of us producing our financial statements, okay? It is a collective process of recording, processing and basically analyzing all accounting events in a certain company. So with that being said, right, again, this is the goal, the end goal of our cycle is to reach to the end, which is to create our financial statements. Now, again, because in a cycle, we know that it goes in a circle, right? Because that's what a cycle is. You start from step 1, you reach to the end of the cycle, then you go ahead and you repeat after that. Okay? Is everything okay? Is someone moving a lot? So, Neela, are you adjusting your microphone? Okay. So as long as you're not adjusting yourself, make sure that your microphone, because I know that you have an actual headset, make sure that your microphone is away from your face. Okay. All right. So what we're looking at the accounting cycle because we're in a cycle, right? Once we start from step 1 and we reach our end of a cycle, we're going to go ahead and repeat that going on and forth. And with that being said, we'll talk about the steps in a minute because again, once we close our books, that doesn't mean we stop our business there. We're only closing out our books to measure a point in our time, in a period of time of our business transactions, right? Once we've closed those out for either whatever your period is going to be, then the next step to do is to continue your business, but starting on another day. And that's what this cycle is referring to, right? With that being said, there are 4 key components or key characteristics of how our financial statements should be, right? And they're going to be the 2 R's and the 2 C's, right? The first one's going to be reliable, okay? Reliable meaning that, again, our information needs to reflect a true statement. So anything that we do, again, that's why we collect our source documents. Our source documents allows us to have some sort of proof to provide to the financial statements that our information is trustable and it's reliable because the statements are true and we have the proper documentations to back up what we say in our financial statement. So our reporting should be reliable. Okay. Second, it's going to be relevant. Relevant meaning that everything that we journalize should be in a relatively similar time period, okay? So for example, you're not going to journalize something 10 years ago and expect you to journalize something that is today because in that kind of sense, it's not relevant because something that happened 10 years ago, right? We have the assumption of monetary, right? That anything can happen with money. It doesn't reflect the same as it is nowadays. Back in the day, even the accounting rules were different, right? So the relevant is meaning if you're going to journalize something, make sure it's relevant within the time period of when you are recording your journals. Making sure that because it is chronologically ordered, make sure you don't add things that are from the past. Okay, making sure that all the transactions are within a relevant time period. Right. The next thing you want to do is make sure that you are consistent, all right? Throughout this entire course, we're going to be learning different methods and different costing methods that may affect our decision when we're dealing with a certain aspect of accounting, all right? And us, in order to be consistent, we need to choose one method and stick with it throughout the rest of its business life. There are some rules and some regulations in regards to that, and you may have to report it to the IRS if you choose to change your method. And again, especially when you're dealing with selling your items or costing out your items, right? Well, when we go into inventory, we're going to be learning 3 different methods, and then or 3 different costing methods and 2 different tracking methods. So you want to be consistent with that, choosing one type of method and utilizing it throughout. So then instead of looking at something that is like switching back and forth, right? At least it also reflects in your income statement, right? Or your financial statements, that if you have something that's you're switching methods every single month, right? You're not going to have some kind of stable or accurate measurement, because how can you measure something? You haven't done it for a long period of time. So that's where you need to be very consistent when it comes to your financial statement. Lastly is comparability. Comparability basically is pretty straightforward. The one thing that you want to do is you want to compare your financial statements to someone else who's either in the same industry as you or just in the same business, general business itself, right? So for example, okay, if you're comparing and contrasting with someone who is also a sole proprietor, right, your financial statements should look similar. And if not, like if they're using different terminology, well then refer to someone who's in the same industry as you. So if you're a merchandising organization, like such as you sell coffee, right? So if I use that example, then my financial statements should look similar to Starbucks, Dietrich's, Dunkin' Donuts, whatever coffee that is out there right now, all right? Similar in a sense where you guys are either, making the same expenses, or even how you're selling your products. It should look similar, but it doesn't have to look the same. And using with that kind of idea, if you are being compared to with your financial statements with someone that's in the same industry as you, right? Your external users are going to use that to kind of see, which company should I invest in? And if your financial statements are all over the place, you have different types of methods that you're using, you can only expect that they wouldn't want to even look at your financial statements. So you want to make sure that your statements is comparable to other companies that are either in the same business or in the same industry as you. Okay. Any questions in regards to the 4 characteristics of financial statements? Okay. Perfect. So now we're going to introduce you to the 10 steps of the accounting cycle, all right? And we're going to look into each and every single one of them with an example that is in here. Now, of course, I'm going to give you the very fine line of what the steps are. So number 1 is to collect your source documents. Okay? Very, very important. You need to, again, this also applies to the transaction analysis that we learned yesterday. You need to collect some form of documentations to even validate that a transaction has existed. Right? Second thing is you're gonna analyze and you're gonna sort the data. So this is where the other half of the transaction analysis comes to play, right? This is where we're thinking about it, we're analyzing it, we're sorting, we're picking out the accounts that we are looking at, right? And determining to use the debit and credit system, right? So that's what number 2 is. You're analyzing and you're sorting the information. Third is going to be you're going to record the transaction in the general journal, okay, which we saw in chapter 3. And then after you journalize it, the next step is going to be posting it to the general ledger, all right, which we also too did get to see yesterday, right? We got to see that after you've completed your journal, right? Once you place it into the ledger, you'll have a running balance in each single account, right? Once we've completed step 4, next is step 5, which is to prepare an unadjusted trial balance. Okay. All right. So this is where we're testing if all of our debits is going to equal our credits. Okay. Then we're going to enter in our adjustment entries. Okay, and we'll talk about what adjustment entries are. Okay. And then step number 7 is going to be to prepare an adjusted trial balance. So that's after completing your adjusted entries, right? You want to make sure that you didn't make any mistakes journalizing while in between. So you're going to complete a adjusted trial balance. Once we finish that and all of our information is good and our debits equal our credits, then the next step is to create our financial statements, which we know what the 4 are. There's exactly 4, so we're going to complete all 4. Once we've done that, then number 9 is we're going to close our books, all right? So this is where we're going to look at our temporary accounts and we're going to close them out at the end of the period. And then lastly, we want to make sure that there's no mistakes in between when you closed out your books, because that entails another journal entry. So in order to finalize and complete the entire thing, that is where we do our final and last post-closing trial balance. Okay? So those are the 10 steps. And again, depending on what you choose your period to be, right? And we'll talk about that in a second, or talk about that after these steps. Since you get to determine how often you want to complete this accounting cycle, will determine when you need to start repeating the process all over again. All right? So let's go ahead and dive into the very first step, which is to collect and verify your source documents. So again, with this being said, it's basically any kind of proof or some evidence that a transaction has occurred, all right? And here, source documents could be anything such as receipts, invoices, checkbooks, right? It could be a bank statement or even a contract, right? So let's go ahead and look at the answer. Let's go ahead and look at the example here. So here I have a receipt on the left side, right? And this is where step 2 comes into play, where we analyze and sort the data. So in order to analyze and sort the data, we're going to look at our receipt right here. What does this receipt tell me? Well, it should answer these 3 questions, right? When did the transaction happen? What was the transaction about? And how did the transaction occur, all right? Or how did you pay? and how much was there. So let's go ahead and take a look at this. So in this case, I have a receipt here, and it looks like I bought some supplies. I bought black pens, I bought copy paper, and I bought ink right here. So when did it happen? Boom. It happened on June 6, 2019 at 10:50 a.m., right? All receipts should have a timestamp. Okay? So we know when it happened. Now the question here is, what happened? And in this case, I purchased office supplies, or I just bought pens and paper, right, for the business. And I went to the store and I was able to recognize it. So here I am looking at my receipt and acknowledging that I have these transactions. Okay, so that is what my what is. What happened here? I bought supplies. Now the next thing is going to happen, the next question is going to ask you is, how did this transaction happen? Well, first off, I went to the store, and how did it happen? Here. I purchased these items, and it gave me a total of $61.09. Now, that's how much I paid for this item. Now, how also answers, how did you pay it? In this case, I paid in cash, right? All receipts will let you know, did you pay via Visa card? Did you pay using your debit card? Or did you pay with cash? So in this case, I know how much I paid. I paid a total of $61.09, and I paid it with cash. All right? So here, I analyzed and I sorted my data by answering these questions right here. Okay? So then the next step here is going to be step number 3, which is to record it into the general journal. So in this case, my scenario is on June 6th, you purchase office supplies for $61.09 with cash. Journalize the transaction. So pretty straightforward. You have the date. You're going to recognize that you bought office supplies, and you're going to credit your account for cash, right? Because you spent the money, right? But you're increasing your assets by $61.09. So in this case, that is how your journal is going to look, right? And I did forget to mention that out of the 10 steps that we looked at, we're only going to be doing steps 1 through 3 for the next 9 weeks into the program, okay? Once we reach our fictitious business, that's where steps 4 through 10 is going to come into play. We're going to practice journalizing a fictitious business. We're going to practice journalizing it first and then posting it to our ledger and then creating our trial balance for either the end of the period. So in this case, for the rest of this class, we will get to see all 10 steps of the accounting cycle, but in the very first 10 weeks of class, or 9 weeks now, we're only going to be looking at steps 1 through 3. Okay? So in this case, here's my journal here. Okay? Step number 4 is going to be posting to the general ledger. So again, here my journal was to increase my office supplies, but also to decrease my cash value. So in this case, I have my little cash account here. I have cash on hand. I started out with $2,000. Now that I spent and purchased office supplies for $61, I now only have $1,938 left, right? This gives me a running balance in each of my accounts. So same thing with office supplies. Since I didn't start with anything on June 6th, I recognize that I purchased a total of $61.09. So therefore, my asset for office supplies is now increased, or has a balance of $61.09. Okay? Once we've done that, then the next step is to prepare our trial balance. And in this case, our main goal is when we're looking at our trial balance is, did we properly debit and did we properly credit each and every single account that happened when we did our transactions? So what we're mainly looking for is at the end of the trial balance, your debits should equal your total credits. And in this case, I'm at 3,860 total debits, and here I have my total of 3,860 total credits. So in this case, yes, once I validated that all my transactions, right, and they balance here, they're equal to each other, then I can go ahead and proceed to the next section. All right. So step number 6 here is going to be entering your adjustment entries. And we will get to talk about this in the next chapter. So what adjustment entry is basically at the end of any given period, an adjustment entry is required, right? And you're going to ask me required for what? Here are some examples of what you can do for adjustment entries. So again, number one would be periodic inventory, right? We need to adjust our inventory, and that's how we do it. It's going to be for periodic inventory, it's going to be done at the end of the given period. All right. Other adjustment entries that we will look into will be depreciation or amortization, supplies expense, okay, cost of material, and also bad debt expense. And we will get to look at all of these in this class. We will get to look at depreciation, and we get to deal with bad debt expense. All right. So here I'm making an adjustment to my office supplies. I've used up a total of $50. So therefore I need to decrease my office supplies by $50, which now, I should have about 11.09 cents left. Okay. And then depreciation expense, because somewhere in my journal I bought a printer. So here I'm recognizing that I need to depreciate it by 83 cents because I've used the product. And we'll talk about depreciation, and we'll make a lot more sense when we move into that chapter. Okay. So once again, we've completed our adjustment entries. Now we got to make sure that our debits and our credits are going to match, because we're dealing with another journal entry, right? An adjustment entry is where we're going to place into our journal. So we want to make sure that we correctly debited and correctly credited our amounts in the proper adjusting accounts. So once I've solved that they are equal, I can move on to the next one, which is to complete your financial statements. So again, we talked about each financial statement that exists, right? There's a total of 4. We are going to start off with our income statement, and order does matter when it comes to completing the financial statements. You always, always, always need to complete the income statement first before completing the rest, okay? So you need to start off with your income statement. Once you solve whether you have a profit or loss, right, this is where you're going to make the executive's decision. Are you going to reinvest into your company, or are you going to pocket that profit, okay? And in this case, my profit is a positive number. And this time, I'm going to choose to reinvest in my company. And if I do, then my statement of equity is going to reflect the amount of profit I am reinvesting into my company. But here, we're going to be totaling up a brand new value of the company, right? We're going to be entering in things that may have affected my equity, such as capital contributions or owner's equity. And then you should get a new balance of equity at the end of the given period. Once we've completed that, then we can go ahead and place that equity right here in our balance sheet, right? Instead of having to recalculate the equity, you already know what it is because of our previous statement. So when we build our balance sheet, right, we have to fit it into the equation where our total assets are going to equal our liabilities and plus our equity. So in this case, since we already given equity, all we need to really solve this for is our total assets and our total liabilities. And making sure that the accounting equation holds true, and if it doesn't hold true, then you've made a discrepancy somewhere in your from transferring from information to another. So again, this is very important that they do end up matching. So here we take our brand new equity from what we solved from the statement of equity. We're going to solve for how many total liabilities you have, and we're going to equal them against the total assets. Okay. Then lastly, we're going to be looking at statement of cash flows. So statement of cash flows, the one component that you need to start off with is your net income or net loss, whichever one that you solved for in your first statement, which is your profit and loss statement, right? So you need to complete that one very first before you can even start completing your statement of cash flows. And again, without spilling too much information about the statement of cash flows, we just want to ensure that the amount of cash that's flowing into the company reflects to the amount that's flowing out of the company. Okay? And yes, once we've complete our statement of cash flows, that's where we can move on to step number 9, which is to complete the when we close our books. Now, again, here, how we close our books is we're going to be closing out our temporary accounts, which means our revenues and our expenses. And how we close them out, we're going to zero out each account and drop them into an account called summary, the income summary. Okay, so as you can see from here, all of our sales, right? The opposite flow of sales, right? Because we're zeroing them out. In this case, we need to debit all of our sales, and we're going to drop them into income summary, right? All of our expenses are also going to be zeroed out into the income summary. So in this case, my income summary is going to be a debit, because in order to zero out all my expenses, you have to credit them. And then lastly, the last step that you need to do is once you've completed the closing out all your revenues and all of your expenses, you need to close out your income summary into your equity. And the great part about this step is if your equity should reflect the total amount of profit or loss that you've incurred in the business. Okay? And then lastly, by looking at that journal, we want to ensure that by us properly closing out our books, right, zeroing out our accounts, that we did it correctly. And by doing so, we're going to do a post-closing trial balance to remeasure that our total debits is equivalent to our total credits. Okay? Any questions in regards to this entire 10 steps? It's a long step. And we are going to talk about that next. So we're going to talk about the accounting period, all right? Now, what does the accounting period mean? It's basically on when you choose to schedule to complete the accounting cycle. So, if it makes sense to you, understanding how long those steps are Are you going to do it daily? Are you going to do it weekly? Are you going to do it monthly, quarterly, semi-annually, or lastly, annually? So in this case, you have the freedom to choose any of these. Now, as we just saw how long it takes to complete the accounting cycle, does it make sense for you to complete it every day? Or does it make sense to you to complete it every month? Now, let's look at a small business shop standpoint, all right? You're more likely to want to do it maybe every month because, every month, you don't have that many transactions to complete, or you don't have that many, your measurability of your revenues and your expenses, right? It could be on a month-to-month basis, right? So with that being said, it's more better to just have it done on a monthly basis because you're not dealing with that many transactions. You might be dealing with maybe less than 1,000 transactions within a month, right? But if you're dealing with a major corporation such as Walmart, who's dealing with a gazillion transactions every single day, does it make sense for you to have to complete the accounting cycle every day? In a perfect world, in a realistic world, that would be ideal because, again, if you're dealing with multi-million-dollar transactions every single day throughout whatever store location you have in every single state, you can only imagine that doing it every day might be your best benefit because you're dealing with so many transactions every day. Now, vice versa, but because you're dealing with so many transactions, it might be better for you to do it at the end of the month or even at the end of a quarter. And most corporations, right? Most business corporations, they do it either monthly or oftentimes they do it quarterly because they always release their financial statements either monthly or quarterly. Okay? And they, of course, they pay the big guys to do this stuff for them. Okay? Going back to your question though, again, it is based on what makes most sense and what is best for your company. Now again, is it necessary for you to have to do it every day? Of course not. Realistically, again, we saw how long it takes us to complete one whole entire cycle. Is it necessary to do it every day? Again, it's going to be depending on your company and what makes sense to you. But I do know, for example, a lot of clothing stores, right? Especially shops that sell like mini boutiques that sell their clothes. They need to take inventory every end of the day. They need to check their register at the end of the day. They need to make a lot of adjustments at the end of the day. So it might make sense for them to do it every day. Just because, again, especially when you're selling clothes, you want to double check your inventory, making sure that you either, one, have enough on hand, two, you also want to make sure your transactions match the amount of clothing that you've sold throughout the day. Because anybody can go in there and steal a shirt, right? So whatever makes sense for you is what you're going to determine whether to do it either daily, weekly, monthly, semi-monthly, semi-annually, whatever you want to do, quarterly. Okay? Any questions in regards to that before I move on to the very second part? Yes. Now, okay, so with that, oftentimes you are more likely to see a company reflect a monthly, they complete the accounting cycle at the end of the month. Or even at the beginning of the month. Whatever works best for them. So when we talk about that, we're going to be talking about calendar year versus fiscal year. So calendar year, right? Now these are more towards when it's not for I guess completing the accounting cycle. These are more for when you need to prepare your taxes for IRS. Okay, claiming what kind of accounting period or what kind of year do you want to go on. So for example, calendar year, right? It's pretty straightforward. It's starting from January 1st all the way to December 31st. So meaning you're going to file your taxes sometime between between the winter, and what you're going to do is you're going to submit it into to IRS around tax season, which is towards April. Okay, we're fiscal year, right? Depending on what makes better sense for you, if you're more busier in the winter or the fall, you're more likely wanting to do a fiscal year that starts in the summer, because you're going to be less busy in the summer. And most government agencies, they actually follow the fiscal year. Because if you think of it this way, during the summer, what usual activities happen for the government? Not really much is going on, right? But let's talk about when we move into the fall. What do we have? We have elections. We have what you call it, annual budgeting for the year. We have to complete all these things. We got new tax rules. So they're going to be super, super busy towards the fall season versus the summer, where there's not really much that you have to do during the summer. So they would choose it to start their fiscal year starting July 1st all the way to June 30th. Okay, and typically it's any consecutive 12 months, right? Starting on the first of the first month and ending on the last day of the 12th month. Okay, and again, this usually is typical for government agencies or any businesses that that are more busier during the winter but less busy over the summer. And you can determine however your fiscal year wants to be. If you want to start on August 1st and end on March 31st, then you can choose to do so, right? As long as you report to the IRS that this is how you're doing your business. Okay. Does anybody have any questions in regards to calendar or fiscal year? Okay. So again, these you choose it so that when you file your taxes, it makes more sense to your business which one you have actually time for to be able to complete all the financial forms and providing all the documents for you to go ahead and file your taxes. Okay, so it's for tax purposes only. Okay, so with that being said, we're going to go ahead and dive right into the actual generally accepted accounting principles. Now, what these are is that the financial statements, okay, they're the methods that are used to be able to prepare the financial statements by following several rules and standards and guidelines, and basically the assumptions that you need to follow, the principles and any constraints that revolve around accounting in general. Okay, and I'm going to go ahead and give you a little background here. The Federal Accounting Standards Board, also known as FASB, right? They are the ones who create the generally accepted accounting principles. They are the ones who come up with these rules and they're the ones that kind of expect every person or any corporation, business, entity to follow these guidelines. And they are responsible for the United States generally accepted accounting principles, okay? So with that being said, GAAP is only used in the United States, right? And then here's another group that is, they're slightly related to us, right? And it's going to be the International Accounting Standards Board, right? Known as ISB. They're the ones who make the international rules on how accounting should be, right? And theirs is going to be called the IFRS, which stands for the International Financial Reporting Standards, okay? And what they do there is, again, their rules and guidelines to do business or how to do accounting based on their rules. And again, they're I guess not founded, but they're established in London, England. So they govern all countries such as Europe, right? And I believe a few Asian countries, if not. But they have their own set of rules, okay? And earlier, Mr. Sanchez has also relayed that even Canada and Mexico have different rules and guidelines that are like GAAP, but they're slightly different, okay? And again, because we're in the United States, we need to focus on the United States GAAP, which is the generally accepted accounting principles. I just want you guys to know just a little history, but also what other people are doing in other countries besides the United States, okay? I understand as a United States, like we want to stand out, we want to be different. So that's why we created our own separate rules and guidelines, okay? Now, when I was in school back in 2014, one of my instructors, right, has informed us that FASB and ISB are working together to create one uniform standardized accounting standards, reporting standards, right? They're trying to make one universal set of rules so that when they do international bookkeeping or do business overseas, that it's seamlessly going to be similar. But that was 2014. We're in 2020, and guess what? Nothing has changed. It's still separate, okay? And of course, things happen over time. These things don't happen overnight, especially with, FASB and ISB. Their rules are so different that it's so difficult to break it down and agree on one concept. And yes, that's a little fun FYI for you guys. Any questions in regards to this? All right. All I need you guys to know is US GAAP and US GAAP only. Okay. So we'll go ahead and talk about our first 4 assumptions. Okay. Okay. Assumption number 1 is going to be that we have the business or economic entity. And what this means is when you are creating a business, especially as a sole proprietor, you need to draw or create some kind of line to differentiate. That's a difficult word. To differentiate as well as keep your business and your personal transactions separate. All right. And a good example is when you go to the bank and you apply for your business license, right? You open up a business bank. Yes, because you're the sole owner and you your name is on the business credit card. The fine line is what you actually do with that business credit card, right? Because this is where ultimately fraud comes into play a lot of time. A lot of people will be like, hey, since I own the business, I own this money. They start making transactions on their business card for personal transactions. And when you get audited, of course, you're going to get audited for a reason because you're not using the business credit card for business purposes. You're using it to take advantage and do it for your personal transactions. Okay? So that's a big no-no. So that's why oftentimes what you have to do is you need to draw that fine line where something is business related and something that's personal, you keep it separate. Now, here's a little question for you, okay? So I'm the business owner. Can I use my business credit card to pay for my personal apartment rent? No. No, you can't. But here is a loophole. I can pull money out of the business, right, to pay myself, right, saying I worked so hard for the last month, I deserve this money. Can I take, once I pull that money and it's either a check written out to myself or I went to the bank and withdrawed it in form of my own payment, can I take that money and then pay my rent? Yes, good. And this is where the business and personal fine line, right? Because in this case, I do own the business. However, I'm not using my business credit card or anything I'm not using my business bank to pay for my rent. I'm properly taking the proper procedures for me to pay myself or withdraw from the company and then pay for my own personal assets, okay? So this one is pretty straightforward, right? Now the second one is going to be the going concern. Going concern basically states that even though you have a foreseen foreclosure, like you know your business is going to be bankrupt or it's going to go out of business, right? You need to continue doing business as if your business is running normal. Just normal. Okay, so for example, Sears, they were going under the waters, right? But they still continued selling their stuff as usual. Some things are marked down on sale, but they still did their operations. They didn't have everything on their lot and say, hey, everyone come grab it, it's free. No, they continued to properly record the sales that they had. Yes, it's discounted, but that's okay. It's because, the main purpose of that business was they're trying to get rid of their inventory. They're trying to get rid of all their assets so they can shut down completely, right? Instead of throwing away all those assets, right? They got slowly rid of it. So what this Sears did was they still had their doors open. They still continued doing these sales just as usual until the day the store officially closed its doors. Okay? Does this concept make any sense? Okay? All right? They're still doing business as usual. Okay? Until the day they completely stop their operations. Right? Now here is going to be the third concept, which is the monetary. Now it's broken into 3 different subsections. Okay, so the first one is monetary unit, and it's going to be based on the most relevant currency. Now, it's pretty straightforward. We live in the United States, so our relevant currency is going to be the US dollar. Straightforward. That's all you need to make sure that you do. If you have an international business, right? Let's say I have a business in China. Can I report my money in yen? You have to convert it to US dollars, and then you can report it. So in this case, we need to use some kind of currency that's relevant in our books. So in this case, our relevant currency is the US dollars, okay? Except for yen, you have to convert it. And on top of that, like, you know, I know this is becoming one of those popular currencies now, cryptocurrency, or it was Ethereum, whatever it's called, the invisible money, coin, Bitcoin, I think it's called now. So yes, it does have a dollar value, and essentially, I don't know how true this is, but I know a lot of people who are really investing in it, and it might actually become the new currency. But right now, it's still in the books. It's still on the works for it. So right now, our currency is right now the US dollar. Right? Number 2 states that monetary is going to be a monetary measurement, meaning that no matter what kind of piece of information that you have, you're going to record in terms of dollar value. So, for example, if I have 20 employees, I cannot record that I have 20 employees. I need to report the total value or the total cost of having 20 employees. So meaning getting a list of all their salaries and wages, right? How much is it going to cost my company to have these 20 employees? And that's where this monetary measurement falls into play. You can't record that I have 20 employees. You can in your journal under your description, but you cannot actually record my salary and wages payable is 20 employees. That's going to be wrong. It has to be in terms of dollar value. Okay. And then lastly, number 3 is going to be the third thing of monetary is going to be stable currency. So again, the unit of currency is stable. Costs and revenues that occurred, okay, in the different times, okay, is going to stay. So basically what this one is pretty much understanding that money, right? We know that our dollar will change in value over time. But what we can do is at least we can make predictions, right? We can make projections of how far our dollar will go. So for example, right, our dollar only changes by pennies every single year. It never really has changed drastically. It hasn't increased from $1 to $5 in 1 year. So with that being said, with the assumption that inflation doesn't play a factor, what we can do is we can make predictions or make projections in the future to be able to utilize as a stable currency. Does that make any sense? So with this being said, it's like, for example, if I'm making a projection, I'm making a prediction that in the future, maybe a month from now, I predict that I want to meet these many sales. That is exactly what I'm talking about. You're making a projection utilizing the dollar the way it is, right, as a stable currency. It's not going to change drastically overnight, all right? And that's what this concept is. Okay. Lastly, number 4, our fourth assumption is going to be the accounting period, okay? So, due to the US GAAP, they are the ones that say, hey, your business, right? I'm going to allow you to get to choose or to break up your accounting period in as many ways as you like, as long as it's within 12 consecutive months. So with that being said, right, again, for the purpose of being comparable, right, to finding some kind of way to measure your profitability and your performance. So the United States GAAP, they allow you to choose how often you want to complete your accounting cycle. All right? So that's just what it is. So make sure that you understand that the United States GAAP, they're also the ones that also tell you need to claim some sort of accounting period, right? You could either do it every day, every week, every month, as long as you're using it to measure performance or some kind of profitability. Okay. Any questions on these 4 assumptions? Okay. Good. So then, go ahead. You say you're good? Okay. So now we're going to be introducing you to the basic principles. Okay? So the basic principles are going to be your first one, which is your historical cost. Now, what historical cost tells you is, by law, by the books of the United States GAAP, you need to record your purchases of any asset. You need to record it at its fair market value the day that you buy it. Okay? So, with that being said, this is where you need to draw a fine line between real estate and actual assets. Because with real estate, right, you have that little friendly thing called equity, right? If you purchase a home at $100,000, 10 years later, it's now worth $300,000. In this case, this is where it boggles down, saying, no, you purchase it at $100,000, in 10 years, it's still $100,000. So in this case, we do not recognize any gains or any losses, right? The day that you purchase your asset is going to be the value that it is that day, and it's not going to realize any extra gains or anything like that until you sell it. All right? That's the most important thing. Until you sell your asset for whatever amount that you purchased it for, that's where you recognize either you had a gain or you had a loss. But you can never reevaluate your assets during the year. The only thing that's an exception to this is going to be your inventory and securities. All right? And we'll talk about that when we dive into chapter 5 and 6. Chapter 6, we'll talk about what happens when you buy inventory and it's been X amount of years and you haven't sold it yet. Chances are it's going to lose its value over time. And we'll talk about that in that thing. Same thing with securities, right? The purpose of even buying securities or bank securities is you're supposed to make a profit. So in this case, that's why these are the exception, right? If you buy a $100,000 bank bond, you already know every single year that you have it and hold on to it, right? You're yielding till it gets to its to maturity, right? It's going to change its value. So yes, in this case, you can reevaluate it because the purpose of a bank bond is for you to get more money out of it. Okay? Next thing we're going to talk about is realization or revenue recognition. So in this case, this is where the accrual basis kind of plays along the lines here. And we'll talk about cash and accrual in a minute. In this case, we're talking about the minute that you sell your items, right? You've earned your revenue. What you're going to do is you're going to record it the day it happens, okay? And that's called revenue recognition. This also applies for expenses as well, right? If an expense has occurred, you're going to recognize it when it happens, okay? And then matching principle and realization principle, they go hand in hand together, all right? If you sold an item for $10, right, you're going to record the $10. And here with the matching principle is you need to have an equal counterpart to match that exact amount. So the example I gave here for matching is, let's say I have a service. I provide it and I charge you $100. When I recognize my service, right, because I placed a dollar value on it, my service is worth $100. So with the matching principle, the day that you've earned your revenue, you're going to match it with $100 cash or whatever amount that you received it for. So in this case, it just says all expenses that are associated for generating revenue is going to be, should match equal. And that's what I'm saying. My service, right, it cost me blank amount of money to get all the materials that I need, right? And so by me recognizing my revenues, I'm going to match it to the exact value that it cost me to produce, okay? And that's what matching principle does. It just matches the number 1 and 1 for your revenue, your expenses to your revenues. And then lastly, adequate disclosure. So, adequate disclosure. So as we talked before, in your general journal, there's only so much room that you can place in there. With adequate disclosure, right? So the example I gave for the monetary unit was that we have 20 employees. Okay? Now, our 20 employees, how many of them are salary-based and how many of them are wage-based? And what position are they? What do they do? And that's exactly what the notes to the financial statement does. It allows you to elaborate what your transaction is. Because, again, in your journal or in your financial statements, you're just going to reflect that you have salaries and wages expense for $20,000. Well, what does this $20,000 represent? Of course, your journal is going to say you have 20 employees, but where the financial statement is, the notes of the financial statement, you can disclose on each individual employee, right, what their status is. Are they the president? Are they the CEO? Are they the management department? XYZ. Are they salary? And are they wages? So, of course, you're going to have your regular employees and then you're going to have executive employees. All right, and that's where you can reveal all that information or disclose it in that portion into your financial statements. Okay. Any questions in regards to these basic principles? Okay. Let me see what we have left. Right now, okay, let's just go ahead and proceed because we're almost done and we'll take a quick break and do the exercises. So here is going to be the constraints and the conventions, all right? First one is going to be materiality convention. Now, this is where we're going to look at a piece of information or a piece of material or something, and we're going to make an executive decision whether we think that this item is significant enough to have a value on it. All right? If not, then you don't need to record it or report it. All right? So the example I used is okay, so for example, I used is gold. If I have gold, right, I know what the value of gold is, right, because I put a price on it. I put a price on it because that's what we use the gold standard on. That's how we get our dollar value from, right? We measure based on our gold. But for my company, right, if I use gold, how does that affect my company? Like, is it significant enough for me to measure and report? Now think about it. Gold is just a precious metal. Is it significant enough for you to put a price value on it? And in this case, yes, because that's what our dollar is on. It's based on us putting a dollar value on it. So that's all that really is. It's just, is it significant enough? And if it's not, you can ignore it. You don't need to report it. You don't need to do anything to it. Okay? Insignificant. I don't know. A picture frame. Okay? A picture frame of your family. All right? It has value to you, but for me, it doesn't for a business. No. Actually, that's a bad example. Go ahead, Mr. Sanchez. Yes. Mm-hmm. Or someone who's in the business of determining value. So, those people who work in the reposition, when they repossess your things, they put a price value on all the assets that you have in your home. So someone like that. Okay, but for a business per se, again, as long as so you have someone, a professional, to determine whether this material can hold some significant value, or you could put a dollar value on it. That's what that convention pretty much entails. Okay. Now the next one's going to be cost benefit. Now this one is pretty straightforward and far as this. Now the definition here is it going to be beneficial for you or for the company per se to provide your financial statements, and you're going to weigh it against the actual cost it took you to produce the financial statements. So in this case, right, I'm going to use this exact example here. I paid the big guys a lot of money to produce me my financial statements. Now, is it going to benefit me to release that to the public? Yes and no, because if it's good, then you're going to attract people who want to invest in you. You're going to attract lenders, right? So in the end, it will definitely benefit you in the long run. But let's say, for example, it cost me so much money to produce the financial statements, and when I do release it to the public, no one really cares about it. It's insignificant to them. All right? Then my cost benefit would be, no, it's not beneficial for me to release my financial statements to the public because, it's not doing good, or it's just so insignificant. So that's what this concept is here. It's just choosing, is it going to be beneficial for you to do something, and weighing it against the cost of doing it. All right? Pretty straightforward. Number 3, conservatism. That kind of goes hand in hand with the whole cost benefit idea. All right? Because what this one's going to allow you to do is you're going to be given an alternative. All right? So in this case, if you were in this scenario where you have the question whether you should release your financial statements or not, you're going to be given an alternative. Yes to release them, or no to release them. And the one that you're going to most likely choose is the one that's going to least likely overstate your assets. Okay? So the example I used for this one is, let's say you're in business of a t-shirt manufacturing company. Your choices are, I either print in the United States or I ship it overseas to get printed. All right? Now, the cost and the benefit here is, if I print it here in the United States, of course it's going to cost me a lot more, right? the United States labor is a lot more expensive, but the benefit I get for that is it can be shipped to me in one day. Like it could be done in one day. So that means I can sell out my items quicker. Whereas if I go for the overseas, it's going to be way cheaper labor. But what's not going to benefit me is that I have to wait one whole week for the items to ship back at me. So I'd be losing 1 week of revenues. However, I can make a bigger profit with that because it costs me less. So my benefit here is it's going to allow me to make a bigger profit. So the alternative here is, which alternative are you going to choose to make to overall not allow you to overstate your assets? And that's what this concept is. You're going to have an alternative and you're going to choose between them. Yes? That won't overstate your assets. Okay? So then the last concept here is going to be industry practices. So when a company, right, or when you're in an industry. So for example, I am in the industry of selling coffee, right? So when I belong in an industry, I'm going to be looking at companies that are the same or in the same industry. So also sell coffee with me. So for example, if I am a coffee business, Starbucks, Dietrich's, Dunkin' Donuts, they're all going to be my competitors. Now, this also goes into comparability too. We're looking at, well, what benefit or what does this industry, what are they doing better than what you're doing, right? And usually, if they're doing something that's way better than you, and they're like making more money than you tend to kind of want to know what they're doing and kind of follow the trend, so then you too can be on the same playing field as those major companies, right? You would tend to follow the same practices or the same rules or how they're doing business. You tend to go in the same trend as them, okay? So what I used here was Clorox and Lysol, right? They are the two major companies that sell disinfectant wipes, right? CVS comes out of nowhere and they want to also be in that industry where they're making cleaning products too. So they decide to follow what Lysol and Clorox is doing and get themselves in there, and they've created their own CVS brand. I don't know what it's called, but they're their own brand of disinfectant wipes. So they saw something they're not in the same industry, but they want to become part of the same industry. And that's that example. So they're trying to go along the same lines, is the same trend as what we are. Okay, same thing with, comparing your financial statements. If Dietrich's coffee, Starbucks coffee, and Dunkin' Donuts, if their financial statements look very similar to each other and yours looks completely off, you would kind of gear towards your financial statements to look, if not similar, but identical to theirs. Okay? Is there any questions in regards to constraints or conventions? Okay? For this class and for this class only, I am not going to test you on constraints or conventions. These are going to be dealing with accounting on a higher level, okay? This is when you actually truly decide to go into business and open up your own business, okay? Either whether it's producing a product or whether it's, looking at cost management, right? That's what cost benefit is, right? And that's where this convention is, right? Making the decision that will least likely overstate our assets. These are more advanced level of accounting. So what I'm going to only test you on is going to be the first eight first 8 generally accepted accounting principles, right? The first 8 rules that I've taught you, okay? So the first one is the assumptions, because this is standard. You need to know this. And then journalizing is going to be based on these 4 principles here. All right? So I'm only going to test you on those 8. All right? But I do want you to at least have a knowledge that you know that they exist, okay? All right. Right now it is 2:45. Let me finish up this last concept, this last slide that I have here, and then we'll go on break, okay? So here is cash basis versus accrual basis. Pretty straightforward. When you're going into business, you have the choice to either choose yourself as a cash basis or you want to be accrual basis, okay? Now, what cash basis entails is you record your revenues the minute cash is received. You record expenses or report expenses the minute cash is spent, all right? Whereas when you're doing an accrual basis, you record the revenues when your service or item has been sold. It's been complete, right? Whether you got paid or not, it doesn't matter. You record it the day it happened, the day that your service has been completed or the day that you sold your product, it's done. You've earned your revenue. That's going to be the day that you record your revenue. Your expenses, same thing. The day that a task has been completed or something has been expensed, right? So most expenses, right? They occur on a given day. So for example, a paint job. If the paint job is completely done, that is where you finally record it that this expense has been completed and it has incurred. The day it happened, you record it. All right? So let's go back. Let's just do an example real quick. For my cash basis, right? If I'm a paint shop person, right? I'm being paid to do service. If someone pays me the day I finish my if they pay me in advance to do a paint job, when do I recognize it? When do I recognize this as good? As soon as you get the cash. But have I completed anything? No. All right. And now flip reverse. If I am a paint job, right? They paid me in advance. When do I record the revenue now? Yes, but I'm looking at an accrual basis though. Well, in this case, they paid me cash in advance. Oh, no. So my question is, looking at the same exact scenario, if they gave me cash to complete a task, right? So they gave me cash in advance because I do a paint job. They paid me in advance. Do I record the revenue now under accrual basis? No, because just because they gave you the cash, whether they paid you or not, was the service complete? So the day that you complete your service, then yes. So the best way to get away from this is when cash is received, under cash basis, when cash is received, you record the revenue. When cash is spent or available to spend, then you record your expenses. Okay? On accrual basis, when the revenue has been earned, it's been completed, it's been sold, you record it, regardless whether you received money or not. For expenses, the day it's completed or the day that it happens, right? You record it. You record the expense. So when it happened, so incurred, meaning it happened right then and there. Okay? Is anybody confused about this? I think I confused myself. All right. Yes. Now, I'll give you a little I guess tip here. Most mom and pop shops are going to be, or any startup companies, they're generally going to start off as a cash basis. Reason being is because, you know, for most sole proprietors, right? If you're a mom and pop shop, you're only limited to your money that you have in your pocket. So the best way to record everything would be cash basis, right? You make a sale of a product and you receive your cash, boom, you record it, right? You're not going to accept IOUs or anything like that because you're a small mom and pop shop. You can only receive money and you can only spend the money that you have. Whereas most companies and all corporations are accrual basis, right? They allow you to owe money. They allow you to be paid in advance as long as they provide a service. So again, looking at $1 million companies such as Walmart, if you look at how many cash sales they actually have versus all the credit card accounts receivables money that they really have versus all their sales. Now, can you tell me, right, if they have 1 billion people owing them money, are they really receiving that cash? Do they really have all that money? Are they really $1 million company? Okay. Yes, so, and then, and we'll talk about that when we move into receivables, when we have those customers that don't pay us back. What do? Our company has to take a loss. And we'll talk about that further on in the course. But in this case, if you do accrual basis, you have to make sure that you have the assumption that your actual sales or your actual revenue may not really reflect the value of your company, because if you're allowing people to owe you the money, or if people paid you in advance, XYZ, you have that possibility where those people may not pay you back, and therefore your sales, you would have to take a loss for those sales. Okay? All right, course review. So again, we talked about the 10 steps of the accounting cycle. We talked about what the accounting period is. We talked about the 4 characteristics of financial statements. We talked about the difference between calendar and fiscal year. And we also talked about the generally accepted accounting principles, which is your assumptions, basic principles, and your C's. Now, this is what I tell my students as a mnemonic device to study this. Your generally accepted accounting principles are just like you learning your ABCs, right? Your assumptions is A, B is your basic principles, your C is your constraints, right? ABCs. And then lastly, we looked at what a cash basis is and what an accrual basis is, okay? Any questions in regards to anything that we learned in chapter 4? Okay, call it at 3 o'clock. So please be back. I'll go ahead and give you guys a 20-minute break. So please be back at 3:20.